Imagine a single room in Washington, D.C., where a small group of individuals makes a decision that instantly changes the cost of your mortgage, the value of your retirement account, and the price of the groceries in your cart. This is not the plot of a financial thriller, it is the daily reality of the Federal Open Market Committee. In a world of volatile markets and shifting geopolitical alliances, the Federal Reserve remains the most powerful economic force on the planet. When the Fed speaks, the world listens, and for a good reason. A mere quarter percentage point shift in the federal funds rate can move over $250 billion of economic activity. But how did a private public entity gain the power to steer the largest economy in history? And what happens when the levers they pull stop working as intended? In the next few minutes, we will strip away the jargon and look under the hood of the American economic engine to see how the Fed controls everything from the dollar in your pocket to the global flow of capital. Stay until the end to find out why the strategies that saved the world in 2020 might be the very same forces threatening our financial stability today. To understand the immense power of the Federal Reserve, we have to look back to a time of absolute chaos. Before 1913, the United States had no central bank. The economy was a wild frontier of boom and bust cycles, characterized by frequent bank runs and panics. The breaking point came during the Panic of 1907, when the entire financial system was saved only by the personal intervention of J.P. Morgan and a handful of wealthy bankers who acted as a makeshift lender of last resort. This vulnerability was unacceptable for a rising global power. In response, Congress passed the Federal Reserve Act in 1913, creating a unique structure designed to balance public interests with private banking expertise. Today, this system consists of the Board of Governors in Washington and 12 regional Federal Reserve banks spread across the country, from New York to San Francisco. This decentralized structure was meant to ensure that Wall Street would not have total control over the nation's money. The Fed was given a dual mandate that guides every decision it makes, to promote maximum employment and maintain stable prices, which the institution currently defines as a 2% annual inflation target. The fundamental problem the Federal Reserve faces is that its two mandates are often in direct conflict. This is the tightrope walk of monetary policy. When the economy grows too fast, businesses hire more people and consumers spend more money, which sounds positive, but this often leads to overheating and runaway inflation. To cool things down, the Fed must raise interest rates, which makes borrowing more expensive, slows down business expansion, and can lead to higher unemployment. Conversely, during a recession, the Fed lowers rates to stimulate spending. But if they keep them too low for too long, they risk devaluing the currency and creating asset bubbles. The complexity of this task was never more apparent than during the global pandemic of 2020. As the world economy ground to a halt, the Fed faced a catastrophic deflationary spiral and mass unemployment. Their response was unprecedented in scale and speed. They slashed interest rates to near zero and launched a massive bond-buying program known as quantitative easing. In just 3 years, between 2020 and 2022, the Federal Reserve effectively printed more dollars than had been created in the entire previous history of the United States. The M2 money supply surged by 40%, and the Fed's balance sheet ballooned from roughly $900 billion before the Great Recession to a staggering $9 trillion at its peak. This massive injection of liquidity prevented a total economic collapse, but it set the stage for a secondary crisis that we are still grappling with today. By flooding the system with cheap money, the Fed fueled a historic rise in asset prices. Stock markets reached all-time highs, and the housing market entered a frenzy. However, as supply chains struggled and demand skyrocketed, inflation began to climb far beyond the 2% target, eventually hitting 40-year highs in 2022. The Fed was initially slow to react, famously labeling the inflation as transitory, but as prices for fuel and food became unsustainable, they were forced into a radical pivot. What followed was the most aggressive rate hiking cycle since the early 1980s. The federal funds rate surged from near zero to a range of 5.25 to 5.5% in little over a year. The impact on the average American was immediate and severe. 30-year fixed mortgage rates, which sat at roughly 2.65% in early 2021, spiked toward 8% by late 2023. This was the fastest increase in borrowing costs in 4 decades, effectively freezing the housing market and squeezing small businesses that relied on low-interest lines of credit. The analysis of how the Fed exerts this control requires understanding the transmission mechanism of monetary policy. It all starts with the federal funds rate, which is the interest rate banks charge each other for overnight loans. While this might seem like a technical detail, it is the base rate upon which almost all other interest rates are built. When the Fed raises this rate, it ripples through the entire economy. Commercial banks raise their prime rates, which increases the cost of credit cards, auto loans, and mortgages. This reduces the amount of disposable income consumers have, slowing down demand. For corporations, higher rates mean the cost of capital goes up. Tech companies and startups, which often rely on future growth funded by debt, see their valuations tumble as the present value of their future earnings is discounted at a higher rate. This is why the Nasdaq is often more sensitive to Fed announcements than the Dow Jones Industrial Average. Beyond interest rates, the Fed uses its balance sheet as a tool. Through quantitative easing, the Fed buys government bonds and mortgage-backed securities, which lowers long-term interest rates and encourages investment in riskier assets like stocks. When they want to tighten the economy, they engage in quantitative tightening, allowing those bonds to mature without replacing them, effectively sucking liquidity out of the financial system. However, the Fed's influence is not confined to American borders. Because the US dollar is the world's primary reserve currency, the Federal Reserve effectively acts as the world's central bank. When the Fed raises rates, the dollar tends to strengthen against other currencies as investors seek higher yields in the United States. This creates a massive problem for emerging markets that have debt denominated in dollars, as it becomes much more expensive for them to pay back their loans. Furthermore, a strong dollar exports inflation to other countries by making their imports more expensive. This global interconnectedness means that Jerome Powell's speeches are analyzed just as closely in Tokyo, London, and Brasilia as they are in New York. The term "don't fight the Fed" has become a mantra for a reason. If the Fed is providing liquidity, markets tend to rise regardless of underlying economic weaknesses. If the Fed is tightening, even the strongest companies can see their stock prices suffer. The central bank's independence is a cornerstone of this system. The idea is that the Fed must be able to make unpopular decisions, like raising rates right before an election, to protect the long-term health of the dollar. Yet, this independence is constantly under pressure from political leaders who want lower rates to spur short-term growth. The outcome of these monumental shifts in policy has created a clear divide of winners and losers. During the era of low interest rates and quantitative easing, the clear winners were asset owners. Those who owned real estate and stocks saw their wealth explode, while savers who kept their money in bank accounts saw their purchasing power eroded by inflation. This has contributed significantly to wealth inequality, as those without assets to invest were left behind by the rising tide of liquidity. On the flip side, the transition to a high interest rate environment flipped the script. Borrowers who were over-leveraged found themselves in trouble. While for the first time in 15 years, savers could actually earn a meaningful return on a certificates of deposit or a savings account. The banking sector also faced a reckoning. As rates rose, the value of older bonds held by banks decreased, leading to the collapse of institutions like Silicon Valley Bank in early 2023. This forced the Fed to once again step in as the lender of last resort, proving that the road to price stability is often paved with financial instability. The long-term consequence of the Fed's recent actions is a world where easy money is no longer the default, and businesses must once again prove they can be profitable without the crutch of 0% interest rates. Ultimately, the lesson of the last few years is that the Federal Reserve's power is both a shield and a sword. For investors, the takeaway is clear. Understanding the Fed's direction is more important than analyzing any single company's earnings report. Macroeconomic trends drive the market more than ever before. For businesses, the era of cheap debt is over, and capital allocation must be more disciplined. For the average consumer, it is a reminder that the cost of money is not static and that maintaining flexibility in one's finances is crucial for surviving interest rate cycles. The Federal Reserve has managed to guide the U.S. economy away from a total depression and toward a potential soft landing, but the margin for error remains razor-thin. If they keep rates too high for too long, they risk a deep recession. If they cut too early, inflation could return with a vengeance. As we move forward, the independence and the data-driven approach of the Fed will be tested by a world that is increasingly skeptical of centralized financial power. The bottom line is that as long as the dollar remains the king of global trade, the men and women sitting at the FOMC table in Washington will remain the most important architects of our financial future. Let me know your thoughts in the comments. Do you think the Fed has too much power over our daily lives, or is this centralized control the only thing keeping the global economy from falling into chaos? The decisions made in the next few months will echo for years to come, and understanding them is the first step toward financial security. This video is for educational purposes only and should not be considered financial advice. Always do your own research and consult with a qualified financial advisor before making investment decisions.